Welcome to another monthly Big Picture episode of the Michael Yardney podcast, where we help investors gain clarity amongst all the confusing mixed messages regarding the property markets. We're helping them so they can develop the financial freedom they're looking for. And each month I get together with leading financial commentator Pete Wargent, who brings decades of perspective to his views, and we discuss the clues in the news as to what's ahead for our economy and our property markets. So in today's show, we're going to discuss an amended outlook for interest rates, because that's changing. Seems to change month to month, doesn't it? What this means for our housing markets. We're going to give you an update on APRA, what it said about its plans to loosen their lending buffers, what America's new president, Donald Trump, may mean for Australia, the Help to Buy scheme, and Australia's ongoing per capita recession. Lots to discuss, but I hope by the end of today's show you'll have some more clarity about what all this means for our economy and our housing markets in 2025. So let's get into it.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Welcome back again, Pete. It's been an interesting year in property, and each month we've had these big picture chats. Now, last week we had a great chat where you summarised your thoughts about the year that's been and gave your thoughts about the year ahead. But my message to those people listening to the show or watching it, if you haven't heard Pete's great insights, after you've listened to the show, don't stop yet, but after you've listened, go back and listen to that show. But welcome back again, Pete.
Thanks, Michael. It's been an interesting year, as you said, and we were just chatting before we hit record about all the various things that have gone on this year. So always interesting to review with the Big Picture podcast.
Well, one of the things we tend to discuss each month on the Big Picture podcast is inflation. And inflation, well, it fell in one side and didn't in the other. Inflation fell to 2.1%, and experts who got our inflation and rate calls wrong time after time this year are now telling us to forget a rate cut in February. I think they're actually right this time. Of course, the biggest mistake maker in some ways was the Reserve Bank, which has been getting its rate calls wrong for the last decade or so, or last 4 or 5 years. I guess the Reserve Bank would have been happy the headline inflation came in at 2.1%, but they would have been unhappy about the one that they really care about, the trim mean inflation, what we call underlying inflation, rising a bit, Pete.
Yeah, so it's a new, relatively newly introduced monthly inflation gauge we're talking about here. So it's considered a bit less comprehensive and a bit less dependable than the official quarterly figures. But as you said, it came in at 2.1% over the year to October, and economists' sort of median expectations have been 2.3%. So you'd have to be happy with that. That's very close to the bottom of the 2 to 3% target range. And I think the one sort of caveat is that those figures have obviously been pushed lower by the government's, particularly the electricity price subsidies. And as you mentioned, core inflation is maybe just a bit above target. But I think if you look ahead, the rental price boom is now easing. And also you'd have noticed, you're up in Brisbane this week, if you drove around, you'd have seen fuel prices in the 150 cents range. Well, that's a long way down from where, in one stage we were up around $2 per litre for unleaded fuel. So I think there's a couple of things there that will just help with that ongoing disinflationary trend. I think if you look at the official quarterly figures for December, it's early days at the moment because those figures don't get reported until February, but it could easily come in for core inflation at 0.5%, or even, who knows, maybe even lower. So if that was the case, then a rate cut would be on the table for February. If it's sort of above that, they'll probably, push out until another quarter of figures, in which case that takes us to May. I think the other thing that's happened since we last spoke as well is that the wages price index was released for the next quarter. And again, it's just continually disappointing expectations, 0.8%. So that's 5 quarters in a row now where those the pressures on wages have been ebbing away. We're below 4% now. That's the first time since June 2023, and we're probably heading down to about 3.5%. So I think there's a lot of different things there saying that we're past the peak for inflation pressures, and probably next year will be a better story.
Well, inflation is affected by a whole lot of factors, as we said, house prices and food and electricity. Our good friend Andrew Wilson believes oil prices are a major factor involved. And yes, the petrol prices have gone down, but it's not just the price at the bowser, is it, Pete? Because oil prices actually have a flow-on effect to transport and manufacturing, a whole lot of other things.
Producer prices right across the economy, actually. Yes. So I think the US government over the past year has been making sure that the oil supplies have kept flowing, and it's certainly kept prices down for crude oil, and that tends to be a good thing right the way across the economy. So we've been through a very unusual few years with the shutdown of all the supply chains, and then the economy reopening, and suddenly population growth soaring back, but things are kind of leveling out again now, and probably by 2025 we'll be back on an even keel.
Well, again, the banks are a little bit divided. Since we last spoke, the ANZ have now come in with Westpac and NAB suggesting the first rate cut's going to happen in May. And by the time people listen to this, it's possible even that the CBA will fall in line with that as well. But the Reserve Bank seems to be a bit more cautious. They're saying they need more than one good quarterly inflation outcome to be confident that such a decline in inflation was sustainable, and they're looking for the quarterly figures. So I'd be surprised about February unless something dramatic happens, but it's going to happen sometime over the next year, we hope, and maybe at this, well, not at the same time, but in line with that, APRA is going to change its lending buffers, and the combination of those two things is going to make a significant difference in borrowing capacity. And when people can borrow more, they do, and they spend it. That pushes up house prices, doesn't it?
It does. So APRA actually, since we last spoke, did an announcement and said for the time being, those lending assessment buffers will stay in place. So essentially, if you go to borrow at a 6.5% mortgage rate today, the bank has to run a stress test that with 3 percentage points added on. So let's call it 9.5%. So it's actually slowing down the rate of borrowing. So the APRA chair, John Lonsdale, gave a few reasons for what he was for their line of thinking, I suppose. They did say that inflation has continued to moderate and the risk of higher interest rates has receded, which is what you already said. I think the regulator is a little bit mindful of potential shocks to households if, for example, a jobs market slows down. And they mentioned potential globally, a bit of geopolitical uncertainty. But I think at the same time, employment growth has been enormously strong. We've added about 400,000 jobs over the past year, and the unemployment rate is still very low. So I think...
and the participation rate is high. So people would wonder, how can that actually happen with more of us employed, more of us in full-time jobs? So our strong labour markets have defied many of the forecasts earlier this year. But I guess part of it was also because a lot of them were government jobs, Pete.
Definitely. I mean, I don't think... I think job vacancies have stayed very high. They've certainly come down from the highs, but there's more or less still a job out there for everybody who wants one. I think the challenge for the property market is basically if you're a dual income couple or a higher income earner with a household income of, let's say, $250,000, or maybe if you've got wealthy parents to act as guarantors, then you'll be fine. I think the challenge is that lower income earners and first home buyers, they're being stress tested for a mortgage rate that they're never going to pay, and they're effectively locked out of the market. So I think APRA is a bit cautious because house prices have increased since 2020, and at least in global terms, Australia has a high level of household debt. But I guess when you run these macro-prudential tools, it benefits maybe the wealthier borrower, but there's a lot of people being locked out at the same time. So that's the challenge.
Well, that's interesting for the property markets moving into 2025 because we know the cycle started in 2023 at the upper end of the Sydney property market, as it often does in the more affluent areas. And then for a couple of years, really, it was the more affordable markets, including regional markets, that did well. But it's likely that moving forward, the more expensive suburbs and middle ring suburbs will pick up again, Pete.
does seem to be. I think APRA is going to keep these tools in place until we've definitively broken the back of inflation. And that could be, as you said, it might be February, it might be May, but I guess at some point, sort of easier credit will come back and people won't be stress tested for that extra 3 percentage points. So, yeah, I think in the short term, it's driven a big decline in building approvals. It's really slowed dwelling construction right down. So we've got high levels of demand from population growth and we're not building enough. So I think, as you said, that will probably tend to suggest that the recovery gets driven by the most supply constrained markets, maybe in Sydney's eastern suburbs, for example, or the affluent parts of Melbourne, and then it tends to sort of ripple outwards from there.
Well, there's also a lot of equity in the people's homes there, the Bank of Mum and Dad helping people downsizing, right-sizing, as I said. So it'll be an interesting market and we'll be talking about it each month. One of the things that people are talking a little bit about is what the effect of the President-elect Donald Trump is going to have on Australia or on the world. In the old days, there used to be that saying, America sneezes and Australia catches a cold. But maybe it's not anywhere. We're not anywhere near as dependent then. But what happens in America really stays in America. Donald Trump's proposing tariffs on imported goods from Mexico, Canada, and China. But this is going to affect us in a couple of ways as well, isn't it?
Well, potentially. Funnily enough, a freedom of information request was issued to the Reserve Bank of Australia to see whether they'd considered the potential impact of tariffs. And of course they had, albeit in maybe a bit of a bullet point fashion. But their general thinking was, contrary to what you might think, this could actually result in downward pressure on the Aussie dollar, downward pressure on government bond yields and interest rates. So I think the reasoning behind that, and it has actually been borne out because the Aussie dollar has fallen from 67 cents to 65 cents since the announcement of the tariffs.
Yeah, just before you and I go overseas, Pete.
Yeah, well, it depends where you're going. So because we go to Europe, I've actually got pounds over there already. But if you're going to the US, for example, it's very expensive now. So, yes, it depends on where you're heading. But I think the RBA's point was that Australia ships a very large share of its commodity exports to China. So especially for iron ore, metallurgical coal, thermal coal, natural gas. And if we have a potential slowdown in the Chinese economy because of the very significant tariffs that President Trump is going to introduce, well, that in turn has some repercussions for a slowdown in Australia. And in fact, if you look at Australia's 3-year bond yield, it finished November at about 3.9%. So it's actually it's down quite a bit. It was at 4.2 only a couple of weeks ago. So maybe the threat of a trade war actually does threaten global growth and growth in China. And in turn, it kind of slows things down for Australia potentially.
Well, let's see how it all pans out. He's made some wild claims. Some of them he'll follow through, others he won't. A stronger US dollar will make a lot of things we import more expensive as well. So we'll see how that plays out. Now, earlier this year, there were talks about a recession. Would high-ish interest rates slow down the economy too much? And so while we actually haven't had an official recession with 2 consecutive quarters of GDP growth, we have had a long run of per capita recession, as we've discussed before. In fact, according to the statistics, it's the longest run of negative GDP per capita since the 1970s, Pete.
Yeah, I think it's an interesting statistical artifact, really, because it's partly driven by the slowdown in GDP as interest rates have gone up, but also population growth has been so strong. If you looked over the financial year to 2024, so our financial year runs to 30 June, GDP grew by about 1%, but population growth was enormously strong. It was about 2.5%. So I guess if you take 2.5 away from 1, you're left with negative 1.5% growth per person or per capita in the economy. So I think at the time of recording, we haven't yet got the September GDP figures, but some of the partial figures have been released, like for inventories, they've been run down quite significantly. particularly in the mining sector. Looks like profits are down as commodity prices have fallen. So we don't know yet what the GDP figures will be for the September quarter as we record this, but it looks like they'll be pretty soft as well. So there's probably a continuation of that per capita recession, which will probably turn around, I guess, in 2025 as population growth slows and gradually the economy starts to pick up again.
We know, of course, that wealth in Australia has gone up quarter after quarter because the majority of Australians, 2/3, own their home, or even with a mortgage. Others have got their money in superannuation. So while we're wealthier, I guess most of us have recognised the cost of living crisis is affecting us one way or another, and people are scrimping and saving in various areas. It'll be interesting when we see what's happened with the Black Friday sales and if that's actually pushed up retail, because things have changed a lot. People used to spend a lot at Christmas and wait for the Boxing Day sales. Now retail has been helping some businesses. The Black Friday sales have been helping some retail businesses bring it all forward.
Absolutely. In fact, just anecdotally, I went to Noosa Civic only 2 hours ago. It was absolutely packed, and this is midweek as we record this. So, and there were more stores than usual as well. So the middle of the shopping centre is rented out on a short-term basis to store holders. So yeah, I mean it's the Christmas shopping just beginning, but it's also the Black Friday sales. Some of that does result in price discounting, which is good for inflation, I suppose. But yeah, it looks like there's still plenty of money out there. I think it's probably a smart idea never to underestimate just the sheer amount of aggregate wealth in Australia. So certainly in suburbia, there's certainly a lot of people in the mortgage belt will be struggling with their mortgages, but just across the whole economy, there's an enormous amount of wealth. In fact, a record high amount of wealth in the Aussie economy. So that's been the challenge for the RBA, just to try and slow down spending, because actually a lot of people, particularly baby boomers, are sitting very, very pretty.
Now, I learned something over the weekend reading about why the Black Friday sales came. Now, of course, they started in America as the Friday after Thanksgiving, but it was because a lot of retailers who were in the red, not making money by bringing on these sales and actually bringing forward sales, suddenly their balance sheets, their cash flows went into the black. So it was something as simple as that. That's what I read. Whether that's the full case, who knows? It's interesting how it's changed some of our habits. Now, the Albanese government got through a whole lot of bills passed in the Senate in its last day or two when the Greens conceded to a number of things. And there were a couple related to property that had been sitting on the table for quite some time. The delays and uncertainties held up the shared equity scheme and also the build to rent scheme. Let's just have a quick talk about both of those. Build to rent, of course, is the concept that large companies, corporations, maybe superannuation funds are going to be given tax benefits to build large complexes, high towers, apartment towers. It could even be estates of houses where tenants are going to have the security of long-term tenure. So they're built to rent for the long term rather than to sell. Hey, isn't that what you and I have been doing for a long time anyway? And I haven't got any tax benefits, Pete. But they're getting tax concessions for it.
Yes, it's interesting you mentioned how Australia tends to mimic what happens in America because just as with Black Friday, the same with a lot of these bills. Student debt forgiveness was almost copy pasted across from the Biden administration. Yeah, build to rent has been quite popular in other parts of the world, especially London. I was actually looking this week at one of the big projects that's come online in Melbourne, I think around sort of South Melbourne. And yeah, the rents aren't cheap on those build to rent projects. So maybe a 2-bedroom unit might be in the region of $950 a week. And for some of them, it's over $1,000. So, but I suppose what they do offer is security of tenure. And also maybe if they can build at enough scale, that will help to bring down rents across the wider market. That's the thinking. But yeah, personally, I don't like it. It's basically encouraging people to be long-term renters, and corporations are the people who benefit, particularly foreign corporations. So yeah, that's one thing. And also the Help to Buy scheme as well, passing legislation this week. So that will get up and running in due course too.
Well, that means that some people are going to, with about a 5% deposit, be able to buy a house. And again, you and I both like the fact that there's incentives for people to get in the market. We want people to be homeowners. The problem, of course, is if you make it easier for them, all it does is push up prices and in some ways kick the can down the road for the next generation, because these people are now going to be able to buy houses, and once that happens, they don't want affordable housing anymore. They don't want property values to go down, do they?
Well, that's right. I think a lot of government schemes, they're easy to introduce, but they're difficult to remove again. But essentially, this one will allow participants to co-purchase a home with the government.
Yeah.
So the Commonwealth helps across all the states and territories, this one. And basically an equity contribution of up to 40% of the cost of a new home. But you can use this for existing homes as well. There are sort of income caps, $120,000 for a couple, or $90,000 for a single person, and there are also price caps. But I guess, as you said, it increases the demand for housing. It doesn't necessarily do anything for the supply side. So, yeah, I think it will all be sort of somewhat buoyant for the market in 2025 at the lower end of the market, and it's good for the people who can use it. But yeah, as you said, once those people are on the ladder with their 2 to 5% deposits, it's not necessarily easier for the next person down the track.
And of course, the government will get its share of any capital growth when you eventually sell the property. So there's no free lunches, but it will definitely help some people into the market. Now, one of the stories earlier this year was this idea of a mortgage cliff, the fixed rate cliff, as people are coming off fixed rate mortgages to variable rates, or high interest rates causing concern. And there's a couple of still very prominent commentators out there talking about and regularly reporting mortgage stress. Now, Roy Morgan recently sent a report out saying that the number of people at mortgage with mortgage stress or have decreased, but they've suggested that 26.2% of mortgage holders are at risk of mortgage stress. That's a quarter of mortgage holders. We're actually not seeing that in late payments or defaults, are we, Pete? So how would you define mortgage stress? What are these people talking about when they're saying, hey, there's all these properties with mortgage stress?
Well, that's right. There's different ways you can estimate this kind of thing. So some people would say if you're paying over 30% of your income, for example, then you're in rental stress or mortgage stress. I think, an easier way to do this, we do have a de facto measure of mortgage stress. And that is simply 30-day mortgage arrears. I think, you can look at what's actually happening. So, for example, S&P Global with their prime arrears, they released the latest figures, and they said basically arrears remained low. They actually fell last month, underpinned by low unemployment, property price growth, which is always good. If prices are going up, people will keep happily paying the mortgage, and also the prepayment buffers that we have in Australia. But if you were to look at 30-day arrears, they're a bit higher for owner-occupiers, about 1.5%, than they are for investors at 1.2%. So interesting, we often see macro-prudential measures introduced to cool investors in the market because they seem to be potentially more of a risk, and yet arrears for investors are much lower than they are for home buyers, and actually overall pretty low. So I guess the Roy Morgan figures are an estimate and they're always high, but the actual arrears are still pretty low and actually fell last month.
One of the factors underpinning that, of course, is the fact that anyone who wants a job has got a job. And if you have a job, if you own a home, you'll cut back on various discretionary items, but still pay your mortgage. In fact, I was speaking to a family friend a couple of days ago who owns a florist shop, and they're not doing very well. People are not buying flowers as much. Made me feel guilty because I haven't bought some for Pam for a while. But they're basically saying people are stashing their cash for other things, but they don't let their mortgage fall into default, do they?
Well, generally, no. In Australia, that seems to be, we've got full recourse mortgages, and people will generally do whatever they can. Usually, I think when we've seen mortgage arrears rise in the past, it's been things like floods in Queensland that saw arrears in some parts of the country. Western Australia, when the mining boom sort of peaked in 2012, 2013, that led to some arrears. But generally, across the board, arrears have stayed pretty low, and banks are quite keen, I think, these days to work with borrowers who do get into mortgage stress. So, yeah, so far anyway, mortgage arrears have been surprisingly low.
Well, we're closing the books for another year of Big Picture podcasts. But before we do go, I'd like to actually recommend, if people are looking for a Christmas present, maybe it's a bit too late, but it's not really, or for your own reading and education, Pete, you've actually written a book just recently with Kate Bakos, and you've had another book that's come out as well. So if people are looking for some smart education with some perspective, can you tell us quickly about those books? And I'll leave a link in the show notes of how people can get them.
Oh, thank you so much. Yes, the buy right approach to property investing, mastering the skills to invest wisely in property. I co-authored this with Kate Bakos, who you mentioned, a fellow Melburnian who's got years of experience in property investing and as a buyer's agent. So that's really a great read for somebody who's interested in buying right every time and making smart decisions in the property market. As you mentioned, I do have another book out called The New Wealth Way, Mastering the Power of Compounding, or Unlocking the Power of Compounding, with Wilkinson Publishing. So that's not just a property book, that's a personal finance and investing book. And
Is
also,
one of the basics you need to understand if you want to become wealthy, isn't it?
absolutely. It's probably there's probably sort of three secrets, I suppose, to creating wealth. One is leverage. The second one is compounding growth, and that's what the book's all about. And the third one, the magic ingredient, is time. But of course, people are always looking for the get-rich-quick scheme. But if you can sprinkle on that magic ingredient of time, then you'll do very well over the long term.
Well, both good reads. I have enjoyed them, and I'm still learning stuff. And so I think anyone who thinks they know it all is going to only fall behind. Different perspectives are important. I'll leave a link for both of those in the show notes so people can get those. Wish you and your family a happy Christmas, a lovely festive season. I know you're going back to your original home for that, and we'll be catching up. We'll miss out on January because both you and I are away, so the shows will be pre-recorded in February for another Big Picture podcast, Pete.
Fantastic. Thanks very much. Been a great year, and always enjoy the Big Picture podcast. And have a great Christmas and New Year, everyone.
Thank you very much. In a moment, I'm going to share my popular mindset message with you. But before I do, I'd like to just follow on my discussion with Pete, where I think you got the hint that we believe 2025 is going to be another good year for property. It's going to be another steady year, but the markets are going to remain fragmented. But if you're like many people listening to this podcast, if you're like many people who read my regular property update blog, you're probably feeling a bit uncertain about the market. You're not alone. Many property investors I speak to are in the same boat. They're bombarded with conflicting information, unsure about the next steps. In one way, there's information overload about all the news about the economy and inflation and interest rates in the housing markets. And at the other end, there's too many opinions, but maybe not as much clarity. And I think that's made some people fear, hold back, stop, and not move forward. I'm sure you've heard Warren Buffett say, be fearful. Well, you may not have heard him say, but you may have heard that he said, be fearful when others are greedy and be greedy when others are fearful. I know there's a lot of people we're currently seeing at Metropole who finished 2024 not doing anything and now regret it when some markets have had significant growth, double-digit growth. So what we'd like to do is help you gain clarity where others see chaos. Why not have a chat with one of the wealth strategists at Metropole and get a clear plan based on solid fundamentals? We always start with talk about a strategic property plan. People come and ask us, where should I buy? How much should I buy? Is this a good suburb? No, what we start with is understanding where you are, where you want to get to. And sure, we're buyer's agents, but we're much, much more than buyer's agents. We help our clients safely grow, protect, and pass on their wealth to future generations through strategic property and wealth advice. So let us help you define your goals, set them, make sure they're realistic, help you track your progress using some fantastic software that we use that you will have access to so you can keep track of it all. And we're going to help maximize your wealth creation, but at the same time, identify and mitigate risks. Go to metropole.com.au, find out how we can help you safely outperform the markets and take advantage of the property cycle of 2025.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to ask you, if you were writing the story of your life, what would the current chapter be called? One useful belief I've developed about life is, when in doubt, zoom out. I found a bird's eye view, a perspective of your situation provides a unique vantage point, the ability to see the landscape around you and the bigger picture. Now, this is especially relevant for property investors who feel stuck and worried about here and now, when their property journey is actually a multi-decade affair. So, in my mind, this question, taking a bird's eye view, as I said, gives you perspective. So let me just suggest some questions that you could ask yourself to get the bird's eye view. As I said, imagine your life's a novel. What would the current chapter be called? Would it be called a chapter of growth and change? Would it be called a chapter of joy and fulfillment? Maybe a chapter of destruction. Could be a chapter of rebirth. Or maybe your chapter would be called a chapter of fear and paralysis. I hope not. More importantly, what would you like the chapter to be called? What would you do to change it? What actions would you have to take today to begin to change the name of your current chapter? We're at the beginning of a new year when there's so many possibilities open to you. If you look back at this chapter, after reading the entire book that you're theoretically writing in my imagination here, what actions would have made this chapter a key inflection point in your journey? So my mindset message to you today is, spend a few minutes thinking about these questions, and I'm willing to bet that they'll spark some new growth on the other side. So the question is, what is the current chapter of your life called? What would you like it to be called? And what can you do to change it to end up how you want it to be? Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this, or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. Oh, and I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcasts, there are 3 little buttons at the top of the player. Or just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour, and you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favorite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?